Folks, welcome back to the Taylor Tax Show, the podcast that helps highly paid, highly taxed, high profile, high net worth, and ultra high net worth taxpayers save a bunch on taxes legally, perennially, and strategically. I'm Terrence Taylor, the co-founder of Taylor Tax, and I'm an enrolled agent. And this is my partner in crime, Big Al Darnell Jr., and he's also an EA. Say what's up, Big Al.
Big Al, and I love my mama.
Folks, today we're going to talk about how to use life insurance to preserve your estate. And Big Al, this is a topic that we can keep short and sweet, but it's a very important topic. So I want to start off with a brief story. And this story is from one of our strategic partners, the founder of one of our strategic partners. So shout out to you, Kenny, Kingstone Financials, Kingstone Insurance. So Kenny is a fellow Harvard Business School alum, and he was sharing with me that some of our fellow alums have made it financially, right? So their estates are worth over 100 million. And so that's not the news flash. The news flash is that a lot of them don't know how to preserve their estate because they don't understand what estate taxes do to your estate. So Kenny shares this story of someone whose estate is worth 100 million after the exclusion of 27 plus million that you could have, the maximum exclusion you could have of the value of your estate. And Big Al, when that person goes to glory to meet the ancestors, to meet God, to meet the universe, to meet the universal creative mind, I believe in all four, right? Or whatever you believe in spiritually, how much of that 100 million are they going to leave behind for their family?
Well, brother, so 100 million if after that exclusion, 27 million if it's, married,
Yeah, yeah.
found jointly, then we're talking about what, 63? Nope, I'm sorry. That's 73 million after taxes. Their family's probably gonna get less than $35 million.
Okay, I'll do one even better for you. So you are right and generous because you're thinking like, they're only going to pay a portion of that and like they got the cash. But
Yeah,
here's the scoop, folks. If you got an estate that is valued at 100 million, the IRS is going to ask you to pay 40% tax on that.
that's right. That's right.
Federal,
Federal.
40% tax. And now the IRS, when it comes calling big out, guess what it says? It says, we take cash.
That's what you're getting at. No, that makes complete
We
sense.
take cash,
Yes,
right?
yes,
So
yes.
for all my Chuck Berry and Go-Go fans, you remember like when we were growing up as teenagers, we need some money. Chuck Berry's Chuck, was it? Yeah, I think it is Chuck Berry, right? Anyway, so the IRS is basically going to say we need the cash, right? And if you don't have the cash, and Big Al, when you're worth 100 million, do you have that 100 million in cash?
No, no, no. It's rarely ever liquid. Not even 90, not even 10% of it is usually liquid.
All right, so imagine if you want to be generous. So like you say, all right, I got 10 million in cash,
Yeah.
right? Now you got 90 million. So that is not in cash. And the IRS is saying, well, thanks for the 10, but where's the other 30? So what are you going to have to do, Big Al?
You're gonna have to sell off quite a bit of assets or sell shares in your company or try to sell a house, like things that are gonna take a lot longer than
Yeah.
just, a year or so.
Well, here's the beautiful thing. As you're going through that, you're going through what's known as a fire sale because you have valuable assets, but the time frame that the IRS gives you to pay is actually, folks, it's not that long, right? So most likely, the story that Kenny was sharing is most likely you're going to probably settle on 50 cents on the dollar. So if you got 90 million that you have to liquidate, you're now down to 55 million. You got the 10 million cash, you got 45 million after you liquidate. So you pay the IRS 40 million. So you thought you were leaving behind 100 million and you just left behind 15 million, Big Al.
That crazy or what? Of
Folks, is this an important topic? Should we talk about this? How could we avoid this? Like, is there a way we could preserve the value of our state?
course there is. Of course there is. One of the things that we've been
Please
talking about
share.
during this entire series, which is life
Yeah.
insurance. Life insurance,
Okay.
y'all. But go
Yeah.
ahead, explain it some more.
All right. So here's the kicker, folks. So when you have an estate, the first thing to recognize is what's going to be taxed and how it's going to be taxed. So if you have an estate and everything in your estate is in what's known as a revocable trust, assuming you even have a trust, right? If everything is in a revocable trust or you don't have a trust at all, The IRS is going to tally up the value of your estate and is going to levy a tax of 40%.
Yep,
Then
that's
the
right.
states themselves may also have their estate taxes or inheritance taxes, but just to keep it simple, we're just going to focus on the estate tax at the federal level. So now, when you put a trust structure in place, you can begin to manage your tax affairs in such a way to minimize the tax that your estate is going to have to pay to the lowest that's legally allowed and not a penny more. So, not a penny more. Here we go. So, how do we do this, Big Al? Set up a revocable trust and then set up an irrevocable trust, because anything that's in the irrevocable trust is not taxed.
There it is.
What's
There
the
it is.
trade-off? Well, you're going to give up control, right? In the revocable trust, you have total control over those assets. In an irrevocable trust, you have trustees who you give control over those assets. But this is one of those principles that is important to keep in mind. The most important thing is not necessarily for you to be focused on controlling those assets. The most important thing is for you to be focused on preserving the value of the assets so you pass it on as a legacy. Now, Big Al, someone's going to ask, well, okay, that's great. So why don't I just put all of the 100 million into an irrevocable trust?
Why?
All right, folks, you still want to enjoy your life while you're here. So what you want to do is you want to figure out like how much is the tax likely to be on my estate?
Yeah.
And then you do a split. So it's called a splitting of assets, right? So not too dissimilar from when we talk about how you shift income to legally avoid taxes, right? Here you're shifting assets to legally avoid estate taxes. So for example, to keep the math simple, we know that we would have to pay 40 million federal taxes on 100 million estate. So we shift 40 million into the irrevocable trust. We keep 60 million in the revocable trust. That simple act alone, Big Al, has just saved 16 million in taxes,
Indeed. Indeed.
right? So let's break that down for folks. How did you save 16 million? Well, when it was worth 100 million, you owed 40 million in taxes. Now you still have 100 million, but because of the splitting of 60 40, 40 is sitting in the irrevocable trust, you don't pay any tax on that. 40% on 40 million is 16 million.
That's right.
So that's number one. Number two, Big Al. Now, here's where life insurance comes in, folks. You put a life insurance policy in place, and that life insurance policy will allow you to plan for the estate tax that you're going to pay on the 60 million. So you need to have a life insurance policy that would have enough value in it that you could actually take out a loan to be able to pay the 24 million in taxes. So that implies that you have to take out permanent life insurance. So either a whole life insurance policy or an index universal life insurance policy. And that policy in your irrevocable trust, you could also decide if you actually set it up as a insurance trust, right? As part of the irrevocable trust, or just put it in the irrevocable trust. So there's some benefits around that. You may want to consult with a estate planning attorney for these, for these specifics. But here's the bottom line. When you have the 40 million in there, you can take out life insurance, basically insuring the estates, insuring 100 million, get to the stage where it's planned that as and when the estate owner goes to meet ancestors, God, the universe, universal creative mind, and whatever you believe in spiritually, the money is now available for through the life insurance policy to pay the estate taxes. So imagine Big Al being able to borrow 24 million in a policy loan um, from the insurance policy in the irrevocable trust and paying the 24 million. So you kept the 60 million, you paid the 24 million in taxes, you kept the 40 million that's in your irrevocable trust, and now you have an asset that also has value in it. So not only did you preserve your estate, Big Al,
Yep.
you could argue that you actually grew it.
Indeed. Indeed.
All right, Big Al. I've been flapping my gums for a while now. Take us home.
No, well, I think it's absolutely phenomenal because most people don't consider the taxes on what's left over. They're thinking, hey, look, I got life insurance and it's going to take care of my children, but is it enough life insurance to cover the taxes on what's being passed down when you're at that level? And as we went over with a different series that we had where we're looking at celebrities that didn't have that died without having a trust and estate plan in place. A lot of people don't have that in place. So whether it's through the extremely ingenious strategy that Terrence just laid out step by step for you, or even if you don't even want to go that deep and you just want to get an eyelid, all right, irrevocable life insurance
Trust.
trust, so
That's
that
what I'm looking for. Yeah.
yeah, that your proceeds could go into there. You could do it that way as well. However, you just need to make sure, in order to preserve the estate, you need to make sure that this estate isn't going to be taxed as much at your death as it would be had you not done any other planning. So yeah, so that's pretty much it. What Terrence mentioned summed it all up perfectly. Make sure that you reach out to us or tax strategists for more detailed, more specific and customized tax advice for you and your estate, especially if you're in this position. And let me tell you, just because your estate might be worth over $27 million doesn't mean that you have all this information or the right people in place. We've encountered plenty that have estates much higher than this that don't have these plans in place, and that's why they're using us. So yeah, reach out to us. Check out Tax Strategies GPT. Thanks so much, and we'll talk to you soon.
All right, folks. See you soon.
Cheers.
Cheers.